topic of the property, plant, and equipments, which is usually also is the quite a big topic, depreciation. So IAS 16 requires why we charge the depreciation. So the first, let's say, and let's understand why do we charge the depreciation. The depreciation means that it's a value, is the amount, is the value of the asset that is being charged to the profit and loss statement. So in the initial slides, when we are discussing, we are saying that you can charge the cost of the property, plant, and equipment into the profit and loss account in first time itself when you purchase it, and then expense will blow up and you will either show a loss or you will show a very little profit. And in the future, the profit will be higher because you are using the asset, you are taking the advantage, but there's no cost to it, right? Because the cost is already being charged. So the depreciation by using the method of depreciation, we are allocating the cost of this property, plant, and equipment into the individual years or the future or the in the future years, so that we can charge the cost of this property, plant, and equipment in the years when it's actually used, right? When the benefit of this property, plant, and equipment is accruing to the entity. So that's the reason. That's one reason why we charge depreciation. Second reason for charging depreciation is usually that if we don't charge the depreciation, then the profit will be higher. You have to pay the taxes. So that's another reason why we charge a depreciation. And the third reason why we charge depreciation is if, let's say, the we don't charge depreciation, the profit is higher, and when you are calculating the dividends, you are distributing every profit, right? So all the profit which you are, let's say, assume we are paying 100% dividend. So all the profit which you are earning is going as a dividend to the outside. So you are not keeping any money for reinvestment into the property. After certain times, let's say 5 years down the line, 10 years down the line, then the asset start to lose value. You have no money left in the business to reinvest or to repair or to change the property in that, because you have already distributed that to the owners or to the shareholders. So in that case, once you want to actually revalue the replace the property, plant, and equipment, you need to raise new capital, which is again is not easy, and it's very expensive to raise the new capital all the time. So those are the few main reasons why we charge depreciation in the property, plant, and equipment. So the question is how we charge the depreciation. How do we know that what is the value that we need to allocate over the next years? We know how long we need to charge depreciation. So depreciation is going to be charged only towards the useful life of the asset. If the useful life of the asset is 5 years, we will charge depreciation in 5 years. If the useful life of asset is 10 years, then the depreciation should finish in 10 years. But how we are going to know what value, at what price we are, at what is the method that we are going to use? That's what we cover in the IAS 16. So in the IAS 16, there is no specific method which is prescribed, right? There are certain methods which can be used for depreciation, but there's no specific method which is prescribed. Sometimes the tax laws usually requires the business entity to charge a straight line method. Many of the tax codes in around the world requires the business to use a straight line method. So straight line method means that if the value of the asset is, let's say, 5 years, total asset value divide by 5, and you charge equally every single month. If the value is 14 years, you divide the total value of the property, divide by 14. Of course, you will remove the residual value, and you divide that into the every year, and you charge that to fixed asset. So that's the normally method of charging the depreciation in the property, right? Or property, plant, and equipment. So there are other methods as well, which we are going to look at. So but the depreciation asset is depreciation starts when it's ready to use. So that's the important aspect first. Let's look at the some more aspects. So the depreciation will start only when the asset is ready to use, not when it's actually used. So sometimes there are spare parts which the entity with the entity is keeping, the business is keeping just for the sake of as a spare in their store. They are actually not using it, but they are ready to use. They you can anytime go and start using it. So you have to charge the depreciation on those spare parts. You cannot say that these assets are not put into use. That's why we are not charging the asset depreciation. You cannot say that. You have to charge it. Let's say you buy a car is available to use, you put it into the garage and don't use it. You cannot say that we don't want to charge the depreciation because we are not using the asset. You still have to charge the asset. You buy a building, constructed it, but you're not moving it, you still have to charge the depreciation. So those unless you classify this as a property held for investment, then you don't need to charge the depreciation. But unless till the time you say that this is a building, this is a business asset going to be used for business, you have to start charging the depreciation as soon as it's ready to use, right? Now, the if let's say the fair value of the property, plant, and equipment is more than the carrying amount, now we are going to discuss at what value we are going to charge a depreciation, right? So, in fair value, which we discussed earlier, if the fair value is more than the carrying amount, then we need to continue to depreciate until when, right? So, the fair value, if the fair value of the property, plant is more than the carrying amount, we continue to appreciate the property. If the carrying value of the property is lower than the residual value, let's say the scrap value, then we will stop the depreciation immediately. Uh, so far as the carrying value of the property is lower than the property, plant, and residual value of the property. So no value, no depreciation if they are not in active use. Now the determinants of depreciation, how we charge depreciation. Determinants of depreciation is the cost of the property, plant, and equipment. What is the cost of the property, plant? The estimated useful life of the property, plant, and estimated residual value. So residual value is again is very important aspect. The cost of PPE we have already identified in the first stage. The second stage is to determine the residual value, which again is the estimate amount in the future. You have to do a present value, calculate it today, because you have to sorry you don't have to do the present value of the residual value because it's an estimated residual value in the future, and by depreciating the value, the property, plant, and equipments will also reach at the end at that same value, so you don't have to recalculate the present value of residual value. So you have to estimate that residual value, and if let's say you have a change in later on, then you can adjust the depreciation formula all every anytime, but the change will affect only the future, not the past. So if let's say you reduce the residual value because of which the depreciation amount is higher, so the higher amount will be depreciated over the remaining life of the asset. You cannot adjust the last year depreciation which you have already charged, right? Then, if let's say yes, if there's a change in the determinants of the depreciation, usually it's a prospective effect. So you can adjust the future depreciation, not the past depreciation. You cannot change the previous one unless you are changing the policy of the depreciation itself. Uh, if there is a change in the cost, if there is a change in the useful life, if there is a change in the residual value, because of the changes in the circumstances, then it's not a change in policy. But if you change just because of any reason, or you want to change from straight line to WDV, written down value, then you have to change from the retrospective effect, not from prospective effect. Change in the method of depreciation, then you have to change in the estimates, or also it does not constitute a change in the accounting policy, so it's going to be a prospective effect. So that's as per the accounting standards in the change of estimates. So there's a similar accounting standard in IAS, IFRS as well, which says that if there is a change in estimate, just only the accounting policy uh, or the depreciation method change, then it's also going to be a prospective change. So The accounting method, the accounting treatment for the depreciation is, so we have a two main methods that are used for depreciation purposes. One is the straight line method, and another is the reducing balance method. So the depreciation will be net book value on the the accounting treatment for change in the depreciation. So if we are changing from straight line to reducing value, then the net book value as of the date of change, and then you will just use the revised percentage uh, of rate and use for the prospective. Right? Or if you are using from the reducing balance to the straight line, or the you change in the useful life or change in the scrap value change, then you will look at the residual value as of that particular date, the net book value as of that particular date, and adjust based on the remaining useful life of the asset, right? So that's the new value. Whatever is the new value because of change in the useful, change in the scrap value, change in the cost, or change in the depreciation method, you will look at the net book value as of that date, and then divide by that by the remaining useful life of the asset. So that's an example here, which we are going to use. So we have not explained about the other methods of depreciation. There is a written down value method. So straight line method is a pretty simple way of calculating the depreciation, where we say that uh, total value divide by the useful life of the asset, and then done. Every year we charge the same method, right? Then there is another method called written down value method, where we say that we will be charging depreciation on the first year. Let's say the total asset is 10,000, and we will charge a specific percentage amount. Let's say the written down value method always work on the percentage. So we determine a percentage which will slowly depreciate the asset over the useful life of the asset. Let's say 10 years, but initially it will be more depreciation. So let's say 20%. So on 10,000 we charge 20% first. So first year is 2,000. Then the balance is 8%, 8,000. Then we charge again on the return down value, not on the fixed amount. Straight line is always fixed amount on the original amount, and then we charge depreciation. So let's say if the asset is has a life of 10 years, then the depreciation amount comes to 10%. 100 divided by 10. If its life is 5 years, then 100 divided by 5, the depreciation rate will come to 20%, because we are charging that to the individual amount, to the original amount. But when we are charging the written down value method, we cannot divide 100 by 5, because in that case we will the useful life of the depreciation amount at the end of 5 years, there will be some amount left for depreciation. So we don't do that. Instead of that, we identify a percentage by using the calculation. In Excel, there is a formula how we calculate the percentage, but we are not going to do that. So we identify the percentage at which the value will be scaled down to nearly zero, or nearly the scrap value at the end of 5 years. So we apply that to the full value first in the first year. In the second year, we will apply on the net book value, the original value minus the depreciation, net book value, and then we use the percentage on the net book value again. So that's the written down value. So every year the depreciation amount will be reducing. So in the first year, it will be the highest. Second year, it will be the lowest. The logic behind this depreciation policy is that the asset will be used mostly in the first year, and then the usefulness of this asset will start to go down year by year. Mostly is for technological assets. Let's say, for example, laptops or computers, servers, where the efficiency of that asset starts to go down after 1 year. When they are new, they are fast, right? They are good. Second year they start to slow down a little bit. Third year more. Fourth year more. After that they are down, they are gone, right? So that's why the sometimes the we use the written down value for only so those assets. If you have majority of the assets which are reducing the value, you can use written down value. But if you think that you will be able to upkeep and the assets are of a nature which are consistently used over a period of time, then you can use the straight line method. There are other methods also to charge the depreciation, for example, like production link method. If you know that certain asset is has a let's say a die, can be used for 10,000 pieces of the can produce only 10,000 pieces of products. Now you know that in the first year I will be only able to sell only 1,000. So and second year will be able to sell 2,000. Third year I will be able to sell 5,000. Fourth year I will be able to sell, let's say, another 2,000 only, because that's the left value of the die. So you will charge the depreciation according to the production schedule, not as per the straight line or not as per the written down value. So there's this is another method. Sometimes we are not able to, because when we written down value also have two different methods. Sometimes we are not able to establish a single percentage. We want to use another method, so we can use like double digit methods, or sum of years method. So we just add the sum of the years and do the proportionate. So there are different methods of charging depreciation, but most commonly used is the straight line method and reducing balance method based on a fixed percentage. So that's the two key methods. And production method is used when we know the production schedule of the asset. Um, Otherwise, we don't normally charge the other methods, right? So there are three main methods. Then if the management decide that they want to charge a certain x amount of depreciation this year and another amount next year, another amount next year, that is normally not permitted, because that's kind of like there's no policy, right? So you need to have accounting process. So the accounting treatment for the depreciated replacement cost is, let's say we look at the example here. So let's say this company own a specified item of PPE that has the cost is $10 million, and the useful life of the asset is, let's say, 10 years. And after 5 years, when the carrying amount is only $5 million, the replacement cost of the asset was $15 million. Now, replacement cost means the revaluation. The revaluation is done, right? So the depreciated replacement cost as of this date is about 7.5 million. As the asset is already halfway through. So when we are changing the let's say we are revaluating the item, we are going to the is going to be look at the as a new asset, right? Because replacement can only be done new, but our asset is already halfway through the our useful life. So it means that the value of replacement will be the original value. So original value was 10, now the value is 5. So if the replacement value is now 15, then the half of the life is already finished. So means the written down value of the replacement will be now about 7.5 million, halfway down. So now the asset is revalued from 5 million to 7.5 million. 7 million, 5 million, because that's the carrying amount of the asset as of today, right? After depreciation, that's carrying amount. Carrying amount is always total value, gross value minus the accumulated depreciation over the period of years. That's 5 value. So at the moment is 5 million. Replacement cost of new asset is 10, of new asset is 15, but if the asset is already used for 5 years, then it will come to 7.5. So it means it gives us a revaluation surplus of $2.5 million. So what we will do is we debit the non-current asset, revalued amount minus the cost, 2.5 million, debit the accumulated depreciation, because we will eliminate whatever is the value. So that will gone, and credit the comprehensive income. So revaluation surplus will be created out of the things. So the non-current asset cost will become to $7.5 million without any accumulated depreciation. So the accumulated depreciation is completely gone. So and the comprehensive income, there is a surplus of revaluation surplus amount, right? So that way we are going to create the value of the